Welcome to our channel. In today's video we'll be discussing the 6 questions that beginner real estate investors should ask themselves before investing in real estate.
Let's dive right in. Number 1. What is your experience level? This question is related to several other questions on this list. Measuring how much experience you require is the easiest way to determine how much assistance you will need.
It may also assist you in identifying the ideal investing strategy for you. Of course, you don't necessarily have to become an expert to have a profitable property portfolio. Still, it's a good idea to understand how the market works and how you may profit from it. It is crucial to highlight, however, that even the most seasoned investors can benefit from the assistance of a strong team. Although their financial advice and analysis may not accurately predict future performance, an expert's viewpoint is extremely valuable to investors. Having a strategy is the best method to approach real estate investing. First, you should know your financial goals, timescale, and design for achieving them. Whether you're a first-time investor seeking capital development or a seasoned investor seeking an additional income stream in the form of rental income, having a practical and well-structured plan will allow you to identify the ideal rental properties, hold on to them, and keep moving forward.
Number 2. What is your risk tolerance? Risk tolerance refers to your ability and willingness to accept a drop in the value of your investments.
When determining your risk tolerance, consider how comfortable you will feel sustaining your assets if the stock market falls dramatically. With a better awareness of your risk tolerance, you can develop an investment strategy that will help you balance volatility risks with the possibility of higher returns in the long run. Investing, in general, is a high-risk endeavor. However, certain types of investments are far riskier than others. At this stage, you must decide how much danger you are willing to take. While commercial real estate investing is dependable, it is not without drawbacks. Before investing, you should understand your risk tolerance. Will you be able to stay financially stable if the market falls for an extended period? Selling and buying houses for a profit, for example, is tenuous at best. This is because you assume that you will be able to repay your initial investment while also profiting. If the market decreases while you own the property, your profit margin will become very thin and even disappear. You should consider low-risk investments if you would be unable to support yourself in the case of a market collapse. Look for low-cost properties in safe neighborhoods. However, if you can withstand some risk, you could realize more significant returns. Number 3. What do you want, cash flow or appreciation? Commercial real estate investors often seek to profit in one of two ways. First, investors recoup their investment costs through cash flow or appreciation. In some circumstances, the highest ROI investments can generate value both through appreciation and cash flow. Understanding whether you intend to attain a high ROI through cash flow or appreciation is essential. This distinction influences the type of property you select. Each sort of investment has disadvantages and advantages. Regular rental income is generated through cash flow investments. If you're using a loan to make a cash flow investment, you'll need to find a property with rental revenue exceeding your monthly payments and maintenance charges. This will necessitate a study into local market rent rates and a detailed understanding of the condition of your home. Cash flow investments are convenient, but they need more effort to locate. It usually entails hunting for a low-cost house with high monthly rent. Achieving a healthy cash flow is less critical if you can wait for capital gains. You'll get your money back with patience as the property's value rises. Of course, this takes more time and has a higher risk, but it also provides more options. Still, the best technique for you will depend on your objectives, so ensure you examine your dreams while selecting a property and determining the type of returns you want. Then, do some market research to identify a location with properties that meet your criteria, and be sure you run the numbers to find a property that will provide you with the returns you require. Number 4. Which industry do you intend to enter? Determining the type of property you want to buy is an integral part of your investing strategy. Different types of property can serve other purposes.
Is it better to buy a house, a townhouse, or an apartment building?
The answer will be determined by the objectives of your real estate investments, borrowing capacity, cash flow projections, housing costs, and the amount of cash or equity you have accessible for a down payment. You can target a range of industries in commercial real estate. Each industry has its own set of market demands and trends. Knowing which industry to focus on is essential for passive and active investors.
Different sectors may require you to make additional investments.
Rental buildings, medical offices, hotels, retail, and many other businesses are examples of distinct investment industries. Again, each sector has its own set of requirements, as well as specific market trends.
Typically, investors will look for industries with higher after-tax profits and growth rates.
Data centers and storage space facilities have been popular spots for commercial real estate investors. In the past years, data center real estate investment trusts saw more than 20% gains. Investing in self-storage buildings yielded similar results and is likely to rise significantly in the future years.
Consider industries with strong returns and growth rates when choosing a commercial property to invest in. Do your homework beforehand because not all investments are made equal. Number 5. Who or what will manage the investments?
To be successful in the real estate industry, a real estate investment manager is essential. Most real estate investors manage their assets to some extent, while more giant corporations and seasoned investors may hire an asset manager for investment portfolio management.
In essence, real estate asset management is a skill set and a career. Hiring someone or something to handle them may be a good idea if you have a considerable number of investments.
However, if you choose this route, you may pay additional costs, such as property management fees or any other fee levied by the investment manager.
This is because real estate managers are not only in charge of asset allocation, risk management, and transactions, but also deal with the land and structures on it. As a result, unlike typical money management, real estate asset management necessitates the use of expert professionals who can maximize the value of assets. However, physical investment managers may be ideal if you want to be more hands-on with your assets. The software maximizes the market value and return on investment of real estate holdings and allows for portfolio growth and development strategizing. Number 6. How do you plan to screen tenants?
There are good tenants and bad tenants in every building. While no screening procedure is foolproof, there are some things to consider that will increase your chances of finding a suitable renter for your rental property. Only those real estate owners with actual investment properties need to screen renters. When selecting renters for your investment property, the investor or landlord must conduct rigorous background checks to ensure that the tenant is deserving of approval. Criminal records are open to the public and can be seen at numerous courthouses. This investigation will uncover both significant and minor infractions. You'll need the tenant's name and date of birth to run one. Remember that anyone with a criminal background may try to fake this information, so check a genuine ID to be sure they are who they claim they are. You can screen all you want, but your instincts are sometimes the best judge of character.
You can have an uneasy feeling about a tenant who appears to be in good standing on paper. Later, it may be discovered that the tenant had applied for the apartment using someone else's identity. Trust your screening, but don't dismiss your gut instincts. A tenant will be evaluated for various factors, including records of evictions, credit rating, background investigation, history of tenancy, and income. It is critical to verify all of these items and others before accepting a renter. Otherwise, the landlord risks a difficult renter who might cost them thousands of dollars in the long run. With the answers to these questions, you should be able to build a strong foothold in the real estate market. So, that's it for today's video. Don't forget to like, share, and subscribe to our channel. Thanks for watching.